NVIDIA just reported third quarter fiscal 2026 results. And the numbers don't look real. Revenue, $57 billion, data center revenue, $51.2 billion, year-over-year revenue growth, 62%. Net income, $31.9 billion. Free cash flow this quarter alone, $22.1 billion. This is not a typo. This is a hardware company posting software-level margins and oil company cash flows. All at once. In this video, we'll walk through 1. What actually happened in the quarter. 2. How NVIDIA is positioning itself as the backbone of the global AI infrastructure. 3. The key risks under the surface, including CapEx saturation, competition, export controls, and inventory buildup. 4. And what this might mean for investors who are wondering, is this the beginning of a long AI supercycle? Or the setup phase of an eventual bubble? For the quarter ending October 26, 2025, NVIDIA reported total revenue, $57.0 billion. Up 22% quarter-over-quarter. Up 62% year-over-year. GAAP gross margin, 73.4%. Operating income, $36.0 billion. Net income, $31.9 billion. Diluted EPS, $1.30, up 67% versus the same quarter last year. On a non-GAAP basis, the story is similar. Operating income, $37.8 billion. Non-GAAP net income, $31.8 billion. Non-GAAP diluted EPS, $1.30, up 60% year-over-year. So not only is NVIDIA growing incredibly fast, it is doing so at very high profitability. In plain English, every dollar of revenue is producing well over 50 cents of operating profit. That's a margin profile many software platforms would envy, and we're talking about selling GPUs, systems, and networking hardware. Even more impressive is what's happening year to date. Over the first 9 months of fiscal 2026, NVIDIA generated revenue, $147.8 billion, net income, $77.1 billion. Free cash flow, $61.7 billion. And out of that, the company has already returned $37 billion to shareholders through share buybacks and dividends. We'll talk about capital returns later, but for now, the key takeaway is simple. This is no longer a cyclical semiconductor story. This is an AI infrastructure utility printing money at scale. Data center revenue for the quarter was $51.2 billion. Up 25% from the previous quarter. Up 66% from a year ago. That means nearly 90% of NVIDIA's total revenue now comes from data center, essentially, AI infrastructure, GPUs, full systems, networking, and software running in hyperscale cloud and AI factories. Why is this so explosive? A few key drivers. 1. Blackwell demand off the charts. Management literally said Blackwell sales are off the charts and that cloud GPUs are sold out. Blackwell offers 10x throughput per megawatt versus the previous generation in certain inference benchmarks. When you're a hyperscaler trying to maximize AI performance per dollar and per watt, that is irresistible. 2. Gigawatt-scale AI infrastructure deals. The press release highlights several huge partnerships, OpenAI, committing to at least 10 gigawatts of NVIDIA systems for next-generation AI infrastructure. Anthropic, starting with 1 gigawatt of compute capacity using NVIDIA Grace Blackwell and Vera Rubin-based systems. To put this in perspective, we're used to talking about data centers in megawatts. NVIDIA is now talking about entire AI factories in gigawatts. This is no longer just about GPUs. It's about a full stack, Blackwell GPUs, Grace CPUs, Rubin for massive context processing, Spectrum X Ethernet networking, NVLink for high-speed interconnect, Omniverse DSX to design and operate AI factories, Bluefield 4 as the data center control plane. Ecosystem lock-in. NVIDIA has partnered with pretty much every key player in the AI space, cloud, Google Cloud, Microsoft, Oracle, X, AI and others. Model makers, OpenAI, Anthropic, and many more. Telecoms and industrial players, Deutsche Telekom, Nokia, South Korean industrial giants. Governments, US, UK, South Korea, Germany. They're not just selling chips. They're selling reference architectures for entire national AI infrastructure. There's also a strategic and geopolitical angle. NVIDIA is celebrating the first Blackwell wafer produced on U.S. soil at TSMC's Arizona facility. That's a signal of U.S. reindustrialization and supply chain localization. They're working with partners to build AI infrastructure in South Korea, the UK, and across Europe. So when you see $51.2 billion in data center revenue, understand that this is not a one-off spike. It reflects NVIDIA becoming the default AI infrastructure standard in much of the world. Let's quickly highlight them. Gaming and AI PC. Gaming revenue was $4.3 billion. Down 1% sequentially. Up 30% year over year. This is almost a rounding error compared to data center now, but it's still a multi-billion-dollar franchise. NVIDIA continues to push new games with DLSS 4 and NVIDIA Reflex. AI-enhanced tools on RTX AI PCs. RTX Remix for path-traced remastering and modding. Gaming is becoming more of a showcase for NVIDIA's real-time graphics and AI capabilities rather than the core profit driver. Professional visualization. Revenue, $760 million, up 26% QQ and 56% YY. The highlight here is DGX Spark, essentially a small AI supercomputer that delivers NVIDIA's AI stack in a compact form factor. Think of this segment as democratizing AI power for enterprises, labs, and developers who don't need an entire data center, but still want a serious AI machine. Automotive and robotics. Revenue, $592 million. Up 1% QQ, up 32% YY. NVIDIA is moving beyond in-car entertainment and into Drive AGX Hyperion 10, a platform for Level 4 autonomous fleets, partnerships with Uber to scale a Level 4 ready mobility network targeting 100,000 vehicles. A long list of robotics and industrial partners, including Amazon Robotics, Caterpillar, TSMC, Lucid, and others. They also introduced IGX Thor, an industrial-grade platform for real-time physical AI at the edge. Individually, these segments are still relatively small compared with data center. But strategically, they are important because they push NVIDIA into the physical world: cars, factories, robots, telecom networks, and industrial systems. If the data center segment is about training and running models, these other segments are about deploying AI into everyday reality. Now let's talk about the financial plumbing, balance sheet and cash flows. As of October 26, 2025, total assets, $161.1 billion. Cash, cash equivalents, and marketable securities, $60.6 billion. Shareholders' equity, $118.9 billion. Debt is very manageable, long-term debt, $7.5 billion. Short-term debt, $1.0 billion. That's a very conservative capital structure for a company generating this much cash. A few items are worth highlighting. 1. Inventories and receivables are ramping hard. Inventories grew from $10.1 billion at the start of the year to $19.8 billion. Accounts receivable grew from $23.1 billion to $33.4 billion. This reflects massive scaling in the supply chain and the timing of large AI infrastructure deals. Right now, that's a sign of growth. But if demand ever slows, these could become pressure points. 2. Free cash flow is enormous. For the third quarter, net cash from operating activities, $23.8 billion. Purchases of property, equipment, and intangibles, about $1.6 billion. Free cash flow, $22.1 billion. For the first 9 months of the year, free cash flow, $61.7 billion. This is enough to invest heavily in new architectures like Rubin, build out partnerships and AI factories, and still return tens of billions to shareholders. 3. Capital returns, aggressive buybacks, modest dividend. In the first 9 months of FY26, NVIDIA returned $37.0 billion to shareholders, mainly through share repurchases, with a small quarterly dividend of 1 cent per share. They still have $62.2 billion remaining under their share repurchase authorization. The message is, we are confident in our long-term position. We're going to make the share count smaller while the earnings power gets bigger. For long-term shareholders, that's a very powerful combination. As long as the AI supercycle continues. Let's look ahead. For For Q4 FY26, NVIDIA is guiding to revenue of $65 billion, plus or minus 2%. GAAP gross margin, 74.8%. Non-GAAP gross margin, 75.0%. GAAP operating expenses, about $6.7 billion. Non-GAAP operating expenses, about $5.0 billion. If they hit that, NVIDIA will be exiting the year at an annualized revenue run rate of roughly $240 to $250 billion. That's more revenue than many national economies generate in GDP from entire industries. Now, let's talk about risks, because no supercycle lasts forever. I'll highlight 4. Risk 1, CapEx saturation at the hyperscalers. Right now, hyperscalers and AI-focused companies are in an arms race. They're buying GPUs and AI systems as fast as NVIDIA and TSMC can produce them. But this comes with a cost. Their capital expenditures are exploding. At some point, boards and shareholders will ask, are we really getting an adequate return on these AI investments? If AI monetization lags AI spending, you could see a slowdown in GPU orders, even if the long-term AI story is intact. NVIDIA's growth today is built on the assumption that hyperscaler CapEx keeps rising. Any pause would likely show up in the numbers quickly. Risk 2, competition, real or just noise? NVIDIA currently dominates the AI stack, but the competitive noise is growing. AMD's MI300 and upcoming MI325. Intel Gothi and other accelerators. Google TPUs. In-house chips at major platforms. Various startups focusing on inference or specialized workloads. Right now, most of these are niche or second-choice options. NVIDIA still wins on performance. Software ecosystem, CUDA, libraries, tools. Breadth of partners. But over time, if any combination of competitors can 1. Match performance. 2. Offer lower ownership cost. 3. Provide a decent software environment. Then NVIDIA's pricing power and margins could come under pressure. Risk 3, export controls and geopolitics. China has historically been an important market for NVIDIA. US export restrictions have forced NVIDIA to design cut-down chips for that market. Those chips have not been as successful as the unrestricted versions. This creates a structural headwind. To NVIDIA's credit, they are expanding aggressively in the US, Europe, South Korea, the UK, the Middle East. But geopolitics can change quickly. As you know from my other videos, geopolitical risks don't show up in the income statement until something breaks. Risk 4, inventory and working capital. We talked earlier about inventory nearly doubling and receivables rising sharply. Today, that's part of aggressively scaling to meet demand. But if the AI spending wave slows even slightly, we might see inventory write-downs. Slower sales recognition. Pressure on margins. This is not a prediction, it's a reminder that parabolic growth rarely stays parabolic forever. So, what does all this mean if you're an investor, or just someone trying to understand the AI landscape? A few closing thoughts. 1. NVIDIA's Q3 FY26 is historic. These numbers put NVIDIA in a different category. This is no longer just a chip company. It's effectively a global AI infrastructure utility with monopoly-like economics for now. 2. The AI supercycle is real, at least today. Demand is not theoretical. It's showing up in tens of billions of dollars in data center revenue, record margins, and record cash flow. 3. But every supercycle eventually tests investors' optimism. Whether that happens through slower CapEx from hyperscalers, increased competition, regulatory or geopolitical constraints, or simply the law of large numbers. We don't know yet. 4. For now, NVIDIA is the scoreboard leader. In every metric that matters, performance, ecosystem, revenue, profit, free cash flow, NVIDIA is far ahead of the pack. Don't forget to like, subscribe, and share this video with someone who's trying to make sense of AI and the stock market.